Good morning, everyone. This is Darius here to present another episode of 42 Macro Bundle Live. I'm joined with my friend Alfonso Peccatiello, author of the Macro Compass, one of the world's best macro subscriptions out there, complimentary. So definitely go subscribe to that. Alfonso, how you doing today, my friend?
Hey, Darius. Oh, good, man. Thanks for the nice words about the macro compass. It's free,
Yeah,
guys. So,
it's a fantastic piece of research. I don't know how you're giving that away for free, my friend. I think you need to put a paywall up, but I digress, my friend. So obviously, a lot to talk about. Some crazy markets we've gotten here year to date. But before we even get into that, let's just, if you don't mind, sharing with the audience your background, sort of kind of
sure.
how we came to be, and then some broader thoughts on the markets.
Before starting the Macro Compass newsletter, which I basically now do full time together with other pro to pro investment services for institutional clients, I used to run a $20 billion multi asset portfolio for a European bank. I did that for the last 3.5 years. Before that, also managed portfolios for the bank. So my career progressed at some point that just realized that there was way too much politics and way too much knowledge being withheld within industry and not shared with the people that would need it the most. That I thought, you know what, I'm just gonna start my own thing here and unchain myself from the corporate politics. And that means probably dropping my title. Fair enough, but who cares about titles? We care about delivering value at the end of the day for people, right?
So let's get right into it. Any thoughts on this sort of recent correction? We in buy the dip mode, we in sell the rip mode. Obviously, sit on your hands ahead of the Fed, but beyond that, any thoughts?
So look, I want to pull up a chart if we can, Darius,
Yeah,
to
of
to
course. I got
explain
them
what
up
I
here.
think being the most important macro driver behind the move. The
Hmm.
macro driver is this is something I posted on my newsletter on Monday. So what I did is I simply put the move. I simply analyzed the move in 5-year forward real yields in America. I took a bi-weekly move in this number in these real yields, and I then checked all the bi-weekly moves between today and 10 years ago on a rolling bi-weekly basis. So I took every 2-week horizon over the last 10 years and I checked how much these real yields actually moved in these 2 weeks horizons. And then I
Hmm.
stuck them in a distribution. You can see it there, right? And basically the mean of the distribution is somewhere around 0 to 10 basis point, plus 10, minus 10 basis point. And then the left side of the tail is like, real yields moved 100 basis point negative over a 2 weeks horizon. The right
Hmm.
side of the move, which is the most difficult for market to digest, and we can talk about why that is the case, actually
Hmm.
gets skewed towards plus 40, plus 50 basis point. Well, over the first 2 weeks of January, you got exactly one of these right tail events where real yields moved by 40 basis point over the first 2 weeks of Jan. 40 basis point. That's a 2% percentile move, which means that only 6 times in 10 years you had a 2 weeks rolling move, which was worse than that. Now,
Hmm.
when real yields go up so fast, so quick, financial conditions tend to tighten, right, Darius? Because if you're a borrower and we live in an over leveraged economy that needs more and more credit to oil through the system to make cyclical growth look good, if you're a
Hmm.
borrower over levered and you need to refinance this debt or you need to project going forward the refinancing of this debt at higher, more expensive levels, in real terms, your borrowing costs have just moved up by 40 basis points in 2 weeks. Well, all your projected cash flows you're going to be able to generate over time, also thanks to this leverage, actually have to be repriced down. So what get
Hmm.
eats the most is exactly what we have seen getting eat the most. Stuff that is highly levered towards very far from now in the future cash flows. So we're talking about the high beta, high valuation driven part of the stock market that then gets it the most because these guys are not able to generate cash flows now. Rivian is not making any cash flow now. The companies within ARC are making very little cash flows now. They're promising you to make cash flows in 20 years from now. And therefore, the discounting rate for them, so real rates, matters a lot, which brings the net present value of their cash flows, which is their stock price, down by a mile. And that's what we have seen happening, basically, right?
What Alfonso's showing here is the U.S. debt to GDP inverted to sort of track the movement, the co-integration with 30-year real yields. These are real long-term interest rates in the economy, and it's exactly as he said. Hey, look, An economy that has suffering from more and more debt is pulling forward more and more future cash flows to sustain current consumption and ultimately current consumption and investment. And ultimately, that robs the economy of future growth. And ultimately, it's a reflexive cycle that continues to perpetuate yields lower. So let's
And
bring this forward to today. I mean, clearly, well, I don't want to say clearly, that's a loaded word. Does the Fed understand this dynamic? Can they be as hawkish as some are calling for? I've heard JP Morgan's Bob Michelle, or was it Bob Michael, out this morning. He's the head of fixed income and currency trading at JP Morgan. He's saying, hey, look, no, the Fed's got to giddy up. They're going to be going. They're going to be QT quantitative tightening. I think they're going to hike at every meeting this year. And so there's a very large pocket of financial consensus out there that believes the Fed is going to tighten very aggressively. What's your thoughts on that?
So the Fed is going to try to tighten aggressively. For aggressively, it means the bond market is pricing it. I think we checked before the meeting, Darius, about 4 hikes this year and 2.5 additional hikes next year. That's what the market is pricing in. And well, if you look back at that chart that I pointed there are, of course, cycles within the like cyclical swings within the long-term structural cycle, right? I mean, you get 30-year real interest rates dropping on basically a trendline fashion over the last 20 years to accommodate the higher and higher leverage that the US economy is taking on. And in that chart, I only showed the federal government debt to GDP because I was lenient. You know, I'm a guy from the south of Italy. I try to be always lenient. But if you overlay the private sector debt to GDP, unfunded liabilities like unfunded pension liabilities, Medicare, Social Security, the US is basically running at about 11 times leverage, debt to GDP,
Ooh.
total economy debt to GDP. It's huge. So the problem is that this debt needs to be, refinanced first, but also serviced. And so in order to service this debt, what you tend to see is that the real interest rates actually tend to drop over time to facilitate additional leverage. So if today I'm levered 4 times and I have real rates at 2%, next year I can be levered at 5 times with real rates at 1%, because my real servicing cost of my liabilities actually shrinks as real rates tend to drop. So I can be more levered, and with the same wage, the same real wage, I can still afford to get more leverage on. It's basically a wealth illusion effect. You get more leverage on, you pull forward future consumption to today and spending power to today, and you make it sustainable by lowering the real interest rate cost of this leverage.
Well, it's technically a Ponzi scheme. Let's be honest here. That's what an economy really is, right?
Pretty much.
These are
So it's the reason why
Ponzi schemes.
It's the reason why, I mean, over the long term, you get people feeling more wealthy, because the first guy who bought a house 30 years ago and he paid it $100,000, he had to borrow at real interest rates that were 7% positive, plus 7%. So he needed a certain amount of income to sustain that, but the upfront payment was only $100,000. Now, fast forward 30 years, the same house costs $500,000. But why is that the case? Because first of all, the real wage of this guy went up a tiny bit year by year, but that compounds, and obviously it helps your cash flow generating activity. But the real tailwind here is the fact that today real borrowing costs for an American are very close to zero. 30-year mortgage rates at some point last summer were below 3%. If you assume a more or less stable inflation around 2%, you get your real borrowing costs at 0.5%, compared to the guy 30 years ago, which was borrowing at 7% real interest rates. So obviously, if your wage is going to bid up, but you get a 7% discount in real interest rate borrowing costs, you can afford much more. The house is now worth $500,000, which is a wealth transfer, upfront wealth illusion transfer to the guy who bought 30 years ago towards the guy who bought today, who still feels he can afford a house worth $500,000. In order for the system to continue, you need another guy in 5 years from now who thinks he can afford a house of $600,000 because his real borrowing costs are even lower than 0.5%. So that's what this chart shows, that as you increase leverage, you also have to lower real interest rates. It's a feature of the system. That's how the system holds together. If now you bring these real interest rates to plus 2% again, with the same amount of leverage, I'm sorry, but the system doesn't hold up together anymore. So, and that's also why, that's also why the Federal Reserve at every cycle can get this terminal rate in the hiking cycle at a lower high. So in 2018, that was 2%. We went at 2% and that was it. At this point in the cycle, because we are much more leveraged than before, the bond market is telling you that they can get as high as 1.5%, and that's it. From my side, I even doubt that 1.5% can be achieved without major hiccups. They haven't even started, and as the bond market has tried to price in 1.5% over the next 2 years, we are seeing already some troubles there, aren't we?
Yeah, definitely. I mean, this is something you and I were discussing before the show, and have been discussing together for a couple months now, which is, can they do what they've outlined from the perspective of the dot plot and not invert the yield curve? Because clearly, I believe this analysis is really headed is saying, hey, look, they can only do so much because this economy needs lower real interest
Yeah.
rates to sustain the growth cycle. So, your thoughts on that?
So basically, if I look at the yield curve slopes, I look at two slopes, 10-year against 2-year and 30-year against 5 years. Those are the two reference slopes. Now, let's look at 2-year against 10-year. It's an easy one. This is trading at about 65 basis points today. So there is a difference of about 65 basis points if I use swaps instead of bond yields. We're being more technical, but for the audience, let's say 65 basis points. Right. So if the Federal Reserve and the 2-year bond yields are pricing now 6.5 hikes over the next 2 years, that's priced in the bond market over the next 2 years. Now, if the Federal Reserve will try to push an envelope, which is even more aggressive than that, which means the bond market has to price 7 hikes, 8 hikes over the next 2 years, then mechanically you get 2-year bond yields going up, and 10-year bond yields can only go up to the same extent, so not flattening the yield curve. If you think from year 3, 4, 5, 6, 7, 8, 9, and 10, the real economic growth and trend inflation the economy can generate while interest rates have reached 2% in America is still relatively robust.
Yep.
Now, the bond market is telling you they highly doubt that to be the case. So let's go back now to the moment where 2-year yields remain around 1.5%, or they price in 6 hikes over the next 2 years. The Fed actually delivers that, and then it stops. Then the bond market is telling you that if that is the case, then they see basically the yield curve being slightly steep. So there is 65 basis point steepness between 2-year and 10-year, conditional on the Federal Reserve hiking 6 times over the next 2 years. The problem is that if growth slows down while the Fed runs this exercise of hiking 6 times over the next 2 years, the term premium priced in between year 3 and year 10 would actually shrink, because investors will become more secure of what the outcome, the model outcome would be between year 3 and year 10, which is if the Fed hikes while the economy slows down, they will have to cut back. And as they have to cut back, I can buy 10-year bond yields being much more secure about what happens in the future. So even then, the curve would flatten. The only way for the curve not to flatten further or not to invert, Darius, would be either if the Fed walks back on their hawkish stance and they say instead of hiking 6 times, we just don't. And then basically you can steepen up the yield curve because the front end doesn't need to be priced so high anymore. Or the Fed delivers these hikes, 4 hikes this year, and the economy keeps on running as nothing is happening. And in that case, you can reprice the yield curve to be a bit steeper. It doesn't seem to be a feasible base case at this stage.
Most recent data, I mean, you were bringing up the most recent PMI data out of the U.S. Composite PMI slowing that's just north of 50. I believe you said X the COVID pandemic. That's the lowest print we've seen in 5 years, correct?
Yeah, so composite PMIs yesterday, in the mess of geopolitics and what's going on in the stock market, which were very much overlooked. But both you and I have been pretty right in calling the cyclical slowdown in growth. I mean, we have been seeing that basically on a second derivative, on a growth impulse basis, happening already from summer last year, but it's now pretty much accelerating. Composite PMIs in America were 50.6, 50.6, so slightly above the 50 mark, which marks a net expansion on a 3 months horizon basis. That's what the PMIs actually try to mark, right? And so this 50.6 number on a composite level in the US, if you exclude the pandemic disaster where PMIs printed at 25 or 30, I mean, that was really ridiculous. If you exclude that outlier, 50.6 is the weakest print over the last 6 years. You have to go all the way back to 2016 to find a composite PMI with a print below 50.6. So, respondents to the PMI survey are telling you they don't feel that confident about the economy running at full steam ahead over the next few months. And that's even before the Federal Reserve has started hiking, which then transfers literally into their borrowing costs. So, I don't think the economy can withhold a lot because it's already entering a cyclical slowdown, and the Federal Reserve is embarking in a monetary tightening experiment exactly at the same point in time.
To look like it's on a, I don't want to say sort of, kind of, they're not going to be sort of out to lunch like they were tightening, like they were in 2018, but it's going to feel like it from the perspective of inflation that'll be still sticky, and the labor market that we're likely to continue to see wage pressures build, at least on a lag, and to some of this tightening. And growth is likely going to be slowing back towards its trend line, and potentially even beyond its trend line as you get into Q4 of this year. So there's going to be a growth scare this year, in our opinion. We think the data already starting to show cracks this early in the process, in our opinion. Although I'll caveat this by saying there's some Omicron in that we track. Obviously, we run nowcasts for countries all over the world, and we're seeing Omicron impact. But to me, the data, the cracks in the data started showing up before Omicron. If you look at this chart here on in our scouting report, this chart shows the real personal income, excluding transfer receipts, so excluding government payments to households, that actually slowed to a -3% SAR in November. This is data through November. We'll get the update tomorrow. Or sorry, we get GDP tomorrow, and then the update on this data Friday. So that was an issue, and then we saw consumer spending, overall consumer spending, goods, services, on a real basis, basically grind to a halt in November. We know the retail sales data was, contracting at a 30% rate, annualized rate in December. You can blame Omicron, you can blame whatever you want. We know consumer confidence. We wrote about that this morning, ticked down in January, led by the expectations component, led by forward-looking measures of income. So those are negative. So you're starting to see this sort of growth slowdown that we've had kind of projected, in terms of our models for quite some time now. This is really nothing new to 42 macro subscribers or subscribers to your work in terms of your credit impulse framework. But I think it'll become new to a pocket of consensus that is certainly out there with this expectation that, hey, look, growth's going to be fine this year. The Fed can do 4 hikes, right? The growth's going to be fine, but it's like they're all smoking the same joint, like passing around. No, bro, growth's going to be fine, bro. No, but 3.8% growth in the U.S., that's 160 basis points north of our trend line. And so we're talking about growing 160 basis points north of our trend line with the record fiscal contraction, with the reduction in monetary stimulus and monetary liquidity, a potential, several stock market corrections, or potentially a big stock market crash. To me, that is the big sort of boogeyman out there that needs to be repriced. Is this sort of expectation that growth takes a material step forward this year?
Hey, but Didi, we were talking on the Real Vision Daily Briefing, I think it was, or was a live show anyway, and you pulled the same chart, and back then the consensus was 4.2% real growth, so it's already 40 basis point down.
Yeah, no,
don't,
totally.
don't worry, they're going to come our way sooner rather than later, because hard data is probably going to prove that we are right, or at least the macro framework we use points to the same direction. We can both be wrong, but who knows. The issue for the Federal Reserve is that, the issue, it can even be a positive thing for them, right? I mean, if growth slows down, it sort of serves them, lends them help in reducing a bit their hawkish stance, right? I mean, if growth slows down, remember why the Federal Reserve is hawkish in the first place, to be seen as proactively fighting the inflationary pressure, which is now eroding Americans' purchasing power. The real problem here is that real wages are dropping. They have been dropping for the last year and a half, and that's obviously not good from a political perspective, but also from a real consumption power perspective. So the Fed wants to be seen at some point. They drop the transitory story. They want to be seen as fighting inflationary pressures. But if real economic growth slows down and supply bottlenecks at some point also will have to ease down, and possibly Omicron helped us on that too, giving us a couple of quarters at least of respite when it comes to a new pandemic acceleration, the Fed might get the help from the real economy, because if inflationary pressures naturally wane down because of what we just discussed and base effects compared to last year, and on top of that, they get signs that the real economic growth is also slowing down, they might want to take the pedal off the gas when it comes to tightening, right? So They then become a little bit less aggressive compared to what the bond market is pricing, which then lends a help to bond yields, which then lends a help to risk assets via the multiple expansion story. Because remember, risk assets, stock market, the 90% of the correction year to date has been multiple contraction. So it's been basically the result of this real yields chart I showed you before, which then feeds into how do you discount future cash flows, which is nothing else than multiples and valuations. So if the Fed gets a help from the real economy, it might be the good old story that bad news is good news, which means, bad news from a real economic perspective helps the Fed to slow down their tightening process and lends a help to valuation. It could be the case, but first, Powell has a gigantic task this evening. Is basically walking on eggs, as we say in Italy. At least I don't know if it's proper English, but he needs to be really careful here, because effectively the market is trying to challenge him to sell some puts back to the market. It's basically trying to say, how far can you push this tightening stance? Because we're challenging you in valuation. I mean, from a valuation perspective, we're down 10 to 12% year to date. The high beta sensitive stuff, the high market cap stuff as well, in some contexts, is down by a mile this year.
Yeah.
Mr. Powell, can you really afford pushing your tightening stance even further than the bond market forwards are already pricing? And do you want to do that? What's your signaling effect tonight, right? What do you think of that, Darius? What do you think they're going to do tonight?
Yeah, I mean, look, so let me start by saying what I think they're going to do has less to do with my expectation on the market. I wrote about this in the last couple morning notes this morning, but one thing, we've been highlighting is this sort of aggressive buildup in implied volatility premia across, risk assets, across U.S. equities in particular. At the same time, we're finally, for the while, the first half of the correction last week, what I'm showing in this chart here, sorry for those who are new, the x-axis of this chart just shows the 1 year z-score of 2-month 25 delta skew. And then the y-axis shows the how we calculate the volatility risk premia on a 30-day forward basis. And, for the most part in this correction, you had a bunch of dots, particularly U.S. equities in particular, kind of hanging out where, yeah, I'm still bullish. I'm a little bit more nervous about this correction. And then finally on Monday and Tuesday, we had the kind of the washout needed to see people really freak out and go rush to bid up skew as well. So now we're in a situation where, if the Fed just satisfies consensus expectations, it's very likely we see a pretty aggressive relief rally. I mean, if you look at sort of the levels of these implied vol premia, basically north of 70%, 80, 90, 100% for a lot of, critical sectors and style factors in the equity market, it wouldn't shock me to see us back up at 4,800 in a matter of weeks if they don't say anything too aggressive.
Yeah.
But so taking it back to what they actually can say, right? The range of probable outcomes is fairly wide, but I don't think the distribution is as fat as, sort of some investors might believe. The distribution, in our opinion, is pretty has a high degree of kurtosis. Digging back to my statistics days, so that it's a very narrow range of outcomes in our opinion, which is, hey, I think modal outcome is they just affirm what they've been sort of allowing to leak into the market over the last few weeks, which is, we might end QE early, i.e. next month. We might do one rate hike in March and reaffirm sort of the March liftoff. And oh, by the way, quantitative tightening is a thing. We're going to be doing some of that. We might get some color on that, although I do believe they have some time to sort of give us. They have time to not have to outline that today. I just think they have to tip their cap towards it and say it's coming in order to affirm the market expectation. If they affirm the market expectation from this point, because we talk about this all the time in terms of helping coach investors on, kind of trading around these catalysts, is not necessarily what happens. It's how the market was positioned into the catalyst. And a lot of those hedges have to come off and, they tend to sort of, catalyze some pretty forceful rallies. So our view is that, hey, look, everything you expect the Fed to do today is probably going to happen. I think the probability of them surprising to the dovish side is, it's high. It's lower than I thought it was on Saturday when we published our Around the Horn. I think we've seen enough of a relief rally already to suggest that investors are starting to kind of inch in that direction. But the likelihood of a hawkish surprise, to me, it seems like it would undo a lot of the sort of goodwill that the Fed has built up in terms of its communication. You go 2 years of this kind of new frame, or not almost 2 years, not quite 2 years, but of this new framework. And if you just shock the market and surprise the market at this particular time, you're going to leave markets in the absence of a summary of economic projections, whereby they update their forecasts, they update their dot plots, the market's going to be scrambling to try to figure out what the Fed's new modus operandi is. And that to me is a negative outcome. That's not good for their inflation mandate. That's not good for their maximum employment mandate, and certainly not good for the financial stability mandate.
Completely agree. So it's enough for Powell tonight to actually throw a small bone to the market in terms of what I call selling out of the money puts to the
Mm-hmm.
market, which if he wants to do that, it just takes him one small hint about growth, the growth impulse slowing down, for instance, naming retail sales or the PMIs they got, or you need one small mention about the fact that QT might start only in late summer, for instance. You don't need to commit to anything firm like dates. I don't think they will, because as you said before, there is no summary of economic projections. This is not the big meeting. They will probably save the details for March. But I think what's really relevant here is the signaling effect that you might want or not want to give to risk markets, given how they're trading, entering a tightening cycle. So,
Mm-hmm.
as you said before, it's a lot about what investors expect and what's priced in, rather than am I going to be right or wrong calling exactly what Powell will do. But there are nuances and there are probabilistic outcomes out there. So when I
Mm-hmm.
used to run institutional money in large size, this is exactly the event where you cannot position as it's black or white.
Totally.
So this is the event where, as you said, it's a pretty narrow path of what are the potential outcomes that can be out there, but the distribution can be skewed in terms of final outcome by few small nuances within the message. So this
Mm.
is exactly the sort of event that has a high kurtosis, but the tails can deliver large outcomes in terms of the impact of the tail event in this case. So were Powell tonight to um, over surprise already nervous markets, both on the dovish or on the hawkish side, you would see, quite a sharp market move. But the probability of that happening is perhaps relatively low. It's much
Yeah.
more likely we're going to be in the modal scenario, the center of the distribution, the high kurtosis distribution, where we're going to get, just an average meeting at the end of the day. And plotting
Yeah.
distributions as well here, because we discussed that before, Darius. At the end of the day, it's what people believe that investing is about is to be right most of the times. What we believe, or I believe, investing is about is to skew the odds your way, which means literally trying to avoid to be in the negative tail when the tail is very fat, and skewing that the risk return and the odds your way, which also means basically getting your gains to be larger than what your losses are, because at the end of the year you will have to book some losses.
Mm-hmm.
Everybody's wrong X times a year. There is no way around that. You got to live with it and you got to manage your risk. But at the end of the day, the P&L of the year is the P&L of the profitable trades minus the P&L of the losing trades. And you will
Mm.
have the losing trades, but you have to manage the risk around those. And that's what we have to try to do at our best, not to be right 100% of the times. You can never be always on the right side of the distribution. You will be on the left side of the distribution. You have to manage how fat are your tails and how deep you go to the left of the distribution. That's really what this is about.
Amen, brother. You couldn't have said it better myself. True pro, true world class pro with us. Appreciate your time, man. Let's get into some questions. You ready for that?
Sure, of course. Shoot at me.
All righty. First one here from Brian says, regarding the TLT options trade you mentioned on Real Vision with Andreas Sinna-Larsen, do you have an opinion on the expiration of the long calls?
So I'm long outright yields, not using options in this
Mm-hmm.
case. So I don't have a strong opinion about that. I have rather an opinion about the delta of the underlying option, if you wish.
Yeah.
And so I've been public about that. I'm long 10-year treasuries, not TLT, but literally 10-year treasuries at 185%. Being sitting on that, because as we discussed before, I don't think that long-term yields can go higher if the Federal Reserve is applying a hiking cycle while nominal growth is slowing down. It's much more likely that the term premium will compress, and therefore I will be sitting on a position that makes carry and brings coupons in while I wait for my thesis to unfold, which is basically that long-term yields have to reprice a bit down from where they were, 185% when I entered my position.
Yeah. You said something that is, let me get rid of this annotation here. So, but yeah, you said something that is, kind of resonates with me personally because we fancy ourselves good at back tests and everything, and what you traditionally see is that, hey, look, when we're when sorry, I'm looking for this chart here as I'm talking. Whenever you see the Fed sort of tightening into a slowdown, it typically is bond bullish. Your term
Yeah,
premium compresses. Obviously the growth and inflation expectations are compressing as well, and so it's hard. The bond market is fighting an uphill battle to have interest rates go higher in that scenario. And so, kind of one thing you could sort of look at here is the policy rate tightening back test and the quantitative tightening back test. And this is just the back test for the 25 plus year Treasury bond index on a total return basis.
yeah,
And as you can see, when they're tightening, when growth and inflation are accelerating, or when growth is accelerating, that's when you're in Goldilocks or inflation. You typically have negative bond prices. But typically when they're tightening into a slowdown, as in quantitative tightening or hiking interest rates, in inflation or deflation, that's when you have some pretty outsized moves to the
correct.
upside. Clearly, the short end of the curve, the short duration trades are getting you tattooed in those environments. But this is how professional fixed income money managers play the curve. I mean,
Yeah,
this is you find all these clever ways to play the curve when you're stuck to when you're left with only playing the curve.
true.
There's no Tesla in fixed income, unfortunately,
That's true.
or
That's true.
fortunately at this point. All right, keep it moving here with the questions. Adam from Red Bank, New Jersey is saying, what do you think of the hypothesis that U.S. debt has been sterilized by international investors? Oh, sorry, the chart moved over there. Sterilized by international investors buying U.S. growth stocks. If we get a VAR shock, growth stocks take it on the chin and the dollar falls and yields rise. It sounds exactly like what we've seen year to date.
Okay, that's an interesting one. So let's talk about the sterilization for a second. So um, the system, the monetary system is built around the dollar being the reserve currency of the world at this stage, which means that the US has the role of delivering as many dollars as they can outside the US, such that the entire economic system can flourish effectively, because 80% of today's trades and economic transactions are priced in dollars. So these dollars need to flow through the world and through foreign entities. Obviously, as this happens, these entities will accumulate dollars, and guys, there is no other way around. They will buy the safest assets they can that yields better than parking this money back at the central bank account, which yields nothing, or even worse, parking it back at the commercial bank account, which yields nothing and has counterparty risk. So they will end up buying treasuries. It's very
Totally.
simple. So the sterilization is a very nice word, but at the end of the day, it's just the feature of our system. The US ships dollars away to the other countries, and the euro dollar system outside the US creates new dollars outside the US jurisdictions, and these new dollars get recycled in foreign economies, and then at the end of the day, they need to get reinvested in some assets. And these assets are, to start with, the safest assets out there, which are treasuries. If you move then and you do this for 20, 25, 30 years, and treasuries have a real negative yield, as we have shown, then you will get some of these investors becoming a little bit more aggressive and building a stock portfolio denominated in dollars. So recycling these dollars in growth stocks. The Swiss National Bank is a great example of that, right? So you effectively built into the system a risk parity levered up long dollar position as a feature of the system. Now, the problem is that if you dry up dollar liquidity from the system, then the whole castle actually falls. And you dry it up when you remove dollar reserves from the system, or where trade flows stop. When trade flows stop, all these entities that have borrowed in dollars, transacted in dollars, and need dollars to survive and oil their economy do not get access to dollars anymore, and they cannot print dollars straight away. It's only the American government and American commercial banks that can do that straight away. But exactly at that point in time, the dollar flow stops. And when that stops, you get all the reversal of this risk parity trade going on. So the intuition is effectively correct.
That's absolutely. Keeping it moving here. Great response, by the way. Don's asking, how do markets and the yield curve react to a higher and/or more sticky long-term inflation rate? Thoughts on that?
Sorry, repeat the question for a second, Darius.
Yeah. How do markets and the yield curve in particular react to a higher and/or more sticky long-term inflation rate?
Good question. So if we would have a more sticky inflation down the road, then inflation expectations would probably have to adapt as well. So if it's really sticky, then it gets priced in inflation expectation. And if it gets priced in inflation expectation, then the problem that we face here is that if wages cannot keep up with this inflation expectation going up, then you have the purchasing power of Americans and people around the world being eroded on a continuous basis. That's unacceptable. So then central banks will try to engineer a way to bring down inflation expectation and re-anchor them at levels that are deemed acceptable, which means you get a much more aggressive reaction. You get an emerging markets reaction at that point, emerging
Yeah.
market central bank reaction, where you need to get ahead of the curve. You cannot even be considered on the curve. You need to get ahead of the curve in that case. So those are the extreme tail scenarios. Deflation, which is devastating for our system, which is highly levered. So you make the real cost of this debt more if deflation hits. The other tail of the distribution is if inflation becomes sticky on the upside, and inflation expectations too, because you probably will erode purchasing power for long enough until even developed market central banks will need to overdo their tightening to get ahead in front of the inflation curve. And when they do that, the entire risk parity, over-levered financial system gets a hit too. So remember, guys, policymakers want to be in the middle of the distribution. They don't want tail outcomes, neither deflation or disentrenched inflation expectations that start to price in 3 or 4% inflation down the road. Nobody wants that. It's a narrative that sells very well, but trust me, nobody in the policymaking circles want to be in the tails of the distribution. Everybody wants to be in the middle.
Indeed. Indeed. Marvin's asking, the market's been focused on value versus growth. Curious, what are your thoughts on what you need to see to increase confidence in reflation getting priced into the market versus a rotation away from cyclical? So I don't know if you have thoughts on that. I can address that as
Great
well.
question. So I'm long Nasdaq and short Russell, which is the exact opposite of what the market's been trying to price in. So far, so bad for my trade. So here's one example where so far I'm wrong. No problem admitting it. The sustainability of this move is all about, I would say the long-term sustainability is about earnings growth, because the other way that Russell can outperform the Nasdaq is that if multiples get it even more, but if multiples get it even more, then you get a very broad market sell-off, and then the overperformance of value would also probably fade away if the whole market is getting hit big times. Then in that case, the Russell gets hit 2 big times, even probably more than the Nasdaq at that point. Now, if earnings over-deliver over the long term, so real economic growth on a long-term basis becomes much more stable, much more strong, then obviously value can outperform growth on a long-term basis. This is both cyclically and structurally, I would say, unlikely, given the work that cyclically both my framework and Darius' framework is showing. Darius, I have to run, unfortunately, so I would love to answer
Oh, yeah. No
even more
worries, my friend.
questions, but I have to jump.
Yeah, no worries. Absolutely. Appreciate you, man. We'll catch you on the Real Vision Daily Briefing later at 4 p.m.
Guys,
Eastern
if
today.
you want to ask more questions to Darius and I, just join the Real Vision Daily Briefing tonight. We'll be live again.
Absolutely, Alfonso. See you later, brother.
Ciao,
All right,
Darius.
I'll stick around. Try to get to the rest of the questions in the queue here. Marvin, so the great question. As you know, we've been talking about the kind of this nascent rotation to pro cyclicality in our dispersion analysis, really dating back to late December, and it very much holds true. If you take it to the chart here, look at our dispersion analysis. One thing we're looking at is the composition of the upper. Am I still on? Sorry, composition of Colin, you put the chart up. Composition of the upper quintile relative to the lower quintile, and so one thing this analysis is really good at is sort of front running sort of big directional changes in the market, and obviously trending changes in sector and style factor leadership, which obviously it's looking to capture. And so we refresh this analysis every day, looking at the month-on-month Sharpe ratio across 50 U.S. equity sectors and style factors, parsing apart the upper quintile relative to the lower quintile, and measuring and mapping the sort of changes in within. And even throughout this entire correction, the biggest correction we've seen since going back to March of 2020, actually, it surpassed the September of 2020 correction. This thing stayed pro-cyclical in terms of financials or energy, financials, value, high debt, ADR sneaking in, Tesla's in there, pro-cyclical. I mean, this whole thing, with the exception of consumer staples, it maintained a pro-cyclical bias. And that, in our opinion, typically when that occurs in a correction, that means the correction is being driven more by repositioning than it is being driven by fundamentals. Although I will argue, as I have argued in the round the horn last weekend, that the big reduction in net liquidity we've seen year to date has been a factor as well. OPEX, last Friday's massive single stock OPEX was a big factor as well. But at least one of those dynamics is behind us. Who knows where this sort of net liquidity dynamic goes on if the Fed Treasury General account continues to rise well past 500 billion. It's currently just shy of 600 billion now. We don't believe it's going that way. It's very unlikely for the federal government to provision itself that aggressively in the absence of a major fiscal initiative, but we'll see on that. So if that line pitters out or starts to go back in a more positive direction, you could very easily see a material relief rally. And I'm actually combining what I'm about to say with Alan's question here, which is what are your thoughts on a possibility of a huge melt up? Yeah, if this net liquidity line starts to go in a favorable direction, so sorry, that's not it. So right now, net liquidity, if you zoom in, we've lost about 450 billion in that blue line, which is the Fed's balance sheet minus the Treasury General account over the past sort of 6 weeks or so. If we just get that back as a function of the Treasury General account, doing something that looks more like this and putting it more in line with this historical range as opposed to in line with this sort of kind of pandemic, special, if you will, that is how you get a material sort of relief rally from these levels. Obviously would have to be in the conjunction of the Fed cutting off the sort of right tail of hawkishness, if you will. It's in today's meeting, and ultimately it'll be fueled by some very aggressive implied volatility premium. This is something we've been writing about since yesterday, going into heading into today and this morning as well. So again, and Larry, last question here, saying, can you mind explaining this crowding chart a little? The x-axis used to be realized volatility, but in fact, it's now the 1-year Z-score of 25 delta skew. I think 25 delta skew is a better proxy for positioning. What I'm really trying to do, and analysis is called crowding for a reason, is to identify extremes in positioning. Are you too bearish? Are you too bullish? Are you somewhere in between from a short-term perspective? Is your medium-term positioning incongruent with your shorter-term expectations? And when you get to those extremes, obviously you tend to see mean reversion from the perspective of asset prices. And so that's, again, why we call it the analysis crowding. But going back to the question I'm answering now, which is, hey, look, rarely have I seen persistent implied volatility premia. And again, we're tracking this across, I want to say 60, 65 ETFs, in U.S. equities in particular, or 26 of those ETFs in the sample is about 50 risk assets in the sample. It's very rare to see an implied volatility on a median basis, so risk assets here, U.S. equities in there, on a median basis north of 35, 40, 50%. We're tracking it, 70, 80, 90% on a median basis. So I said this morning, I was kind of joking, but I'm actually not. If Jay Powell, all he has to do is avoid coughing wrong tonight, and you could have a mother of your face ripping off short squeeze from this particular point. And so that's something we want everyone on Team 42 to be aware of. It's irrespective of the medium-term view and how that might change from the perspective of our 4 horsemen of market risk. I think the higher probability scenario right now is respecting the fact that the market setup into the catalyst is one that should deliver a pretty material recovery and response to pretty much anything at this point, unless, again, they sort of introduce the hawkish right tail of the distribution. All right, last question here. Curb Conrad, how you doing, Curb, is asking, how do we square the idea that the U.S. dollar is strong in deflation, but as a headwind if foreigners have to get out of U.S. growth stocks? What's the net coming out of this? And this is something, great question, because we've been sort of thinking about this for a while now. But we sold our dollar exposure a few weeks ago. It was with the context of, hey, look, we're in a correction here. We're in a deflation regime, but the dollar is actually starting to broke down from bullish to neutral from the perspective of our volatility adjusted momentum signal. And in our opinion, up until this sort of last couple of days, really starting middle last week, up until that point, the market was sending a very clear message that, hey, look, the unwind of this U.S. exceptionalism that, in our opinion, was driven by, an aggressive acceleration in U.S. growth, not only on absolute terms, but relative to the rest of the world, an aggressive acceleration in American inflation, which obviously meant American nominal GDP was much higher than everyone else's. And then also some pretty aggressive balance sheet expansion out of the Fed, very aggressive fiscal policy expansion. I think we spent 25% of our GDP on fiscal programs in the past, kind of couple fiscal years. And so all that stuff is now going in the wrong direction. And so a lot of this sort of, dollar strength we've seen, into the year to date, kind of, as in our opinion, is a function of investors flowing capital into the United States economy to take advantage of a lot of those dynamics. And, so it may be the case that, hey, when we ultimately transition to deflation, the big deflation that we've been calling for a while now, I still think that's a spring to summertime event. When we see that big deflation, it'll be interesting to see whether or not the dollar does what it's done here, or whether or not the dollar did what it's doing here, kind of throughout the month of December. So I don't think we have to make a call on that today. I think the call today is pretty clear from today. So with that, Darius Dell presenting our 42 macro bundle for Wednesday, January 26, 2022. Thank you to our friend Alfonso Peccatiello, and definitely go check him out on the Macro Compass. It's something I read on a regular basis. It's truly it's not only institutional grade finance, it's high end institutional grade macro research. So definitely check that out and have it complement some of the decisions that you're making from a macro risk management perspective. Catch you back here next week.